Credit is a necessary and probably the most important ingredient for economic growth, which is reflected in positive correlation between credit and GDP growth. However, the link between bank credit and GDP has weakened over the years as banks have started accommodating companies through other sources like commercial papers and bonds, etc. And more importantly, as NBFCs have also enhanced their share. Let's do a three-point analysis of the current credit growth vis-à-vis GDP growth and the outlook on it going forward. 1. What's the current credit to GDP growth situation? Well, in a statement after the monetary policy meet, RBI Governor Urjit Patel alluded that credit growth is comfortably in excess of nominal GDP growth, indicating sound health of the economy. The nominal GDP growth is hovering around 10%. At the same time, banking system credit growth has improved to around 15%, the highest in 5 years. While this is definitely a positive trend, the moot question arises whether the mid-teen credit growth is sustainable. Now, while this is difficult to predict, we look at the two main drivers of banking system credit growth in October 2018 to preempt a trend, if any, which is credit to industry and credit to NBFCs. 2. What's the trend in industry credit now? Credit to industries has been one of the main culprits behind falling credit growth numbers in the past 7 to 8 years. From expanding at more than 20% in FY11, credit to industry has seen a contraction and flattish growth in the recent years. Though sluggish, it has expanded by 4% year-on-year at the end of October, hitting a 12-month high. Recent monetary policy statement clearly mentioned that there has been a significant acceleration in investment activity, and high-frequency indicators also suggest that it is likely to be sustained. Now, given these prospects, industry credit growth could continue to expand and support the overall credit growth. 3. How has been the lending to NBFCs? Credit to NBFCs has grown by a whopping 56%. That's a 7-year high. The current spurt in credit to NBFCs reflects the bid to provide liquidity to these kind of companies, to ease liquidity situation and to enable NBFCs to raise funds from banks. Now, RBI has also increased the concentration limits for banks' exposure to individual NBFCs. This will create more headroom for bank on lending to NBFCs. The overall credit pie will continue to expand at a healthy pace as NBFCs are expected to cede their market share in favor of banks, giving boost to the banking system credit growth.